makes this difficult and different is the returns are more of what you would, if you say, well, I'm 3 months away from my top, I'm going to start getting very defensive here. You might miss what would normally be 3 or 4 years worth of returns.
Welcome to the Rose Show podcast. Thank you so much for joining us. I am so excited to be here with David Hunter. He is Chief Contrarian Macro Strategist with Contrarian Macro Advisors. You have an excellent track record, and we always turn to you for your profound forecasts in the markets as well as the economy. And this is our second time meeting. How have you been, David?
Yeah, hi, Rosanna. Thanks for having me back. Great to see you.
Great to see you as well. We met last summer, so I'd like to know if there's any changes or updates. And so just to let the audience know where we were at was we have melt up for the markets, and the final stage of this 41-year secular bull cycle, which started back in 1982, totally makes sense. And the continuation of this strong market that leads to this vertical melt up, and that's different than a rally. It's a melt up is more extreme. So do you still see that? And give us what you think timeline wise for this year.
Yeah, the melt up view hasn't changed. Basically the overall framework of a melt up into a secular top followed by a global bust and bear market has not changed at all. If anything, my conviction is high or higher than ever. And numbers have changed a little bit in terms of my outlook, but pretty much the same thing. We're coming into this year after a strong last 2 months of last year. And not surprisingly, the market's kind of marking time here for the last few weeks at a high level. I mean, basically the S&P is off 1%, and the Nasdaq's off a couple percent from its highs. So people are reacting because it's not going up every day and wondering if this thing's rolling over. I don't think so. I mean, it can certainly have a 3 or 4% pullback if it wants to, but I don't think that's even necessarily going to happen. We may just have kind of this very high level short-term consolidation, because what I'm seeing out there is people very quickly who were kind of following the tape up and getting more bullish as it went to new highs. You get a couple weeks where it's kind of choppy, and all of a sudden people are starting to question the market. You hear people coming out saying, "Oh, this is a top. We're getting a double top. It's rolling over." That wasn't the view 3 weeks ago when the market was, had just finished 2 months of running. So, in other words, I think people have, and this is classic investor behavior, they had fought the market all the way up from October of 2022, when we bottomed at 3,500 on the S&P, all the way up to probably 43 or 400. It was pretty much assumed it was a bear market rally that would ultimately roll over and go to new lows. And once it got above that, there was more questioning of whether this thing had more legs than they thought, and people got, some people got more bullish. There were still plenty of bears. Once we got, above 4,600, we had pulled back and then ran back up over 4,600. You heard a lot more of the bears convert over to bullish. Still nervously bullish, but bullish. And what I've seen in this last few weeks is every little sell-off, it takes away some of that bullishness, and people start coming back the other way very quickly. So what I say is there's been more bullishness built into the market, but without any conviction. So they're really there just because the tape was going up. The momentum was there. So now I feel like you don't need a big pullback to get that sentiment back to a level, or what I call the wall of worry, built back up to fuel further advance. And that's again, I don't try to call the next day or the next week or even the next several weeks, but I wouldn't surprise me if this thing doesn't go a lot lower and turns back up again.
Wow. Okay, let's talk timeline. This is an election year, 2024. We're in January right now. What are your thoughts for this melt up? You think it's going to happen before the election and sometime this summer, maybe? And then we're going to see a change at some point later in the year or maybe next year?
Yeah, I actually think it's probably a first half event. So we could see the top in the market in the second quarter. I don't, it'd be awfully fast for it to get to there before the second quarter, but I think we could see it in the second quarter. Doesn't have to. It could, it could stretch. I've been guilty of thinking it would happen sooner many times. But the key is it's the end of 41 years of running. We had back in 1982, we had single digit PE multiples. Today we're at 20 and we've been higher than that. This is the end of something that's been going on for decades. I'm not so worried about which month it's going to happen. I think that, I continue to give my opinion that I think it could happen, in the next few months, second quarter. But if it stretches a little bit more than that, so be it. And in terms of levels, I think, I just put out my first quarter letter and I just raised my targets there. I had a 6,000 to 7,000 S&P target, saying it would, somewhere in that range was where I saw the top coming. I've dropped the lower end of that range and my target is now 7,000. So that's an indication again that my convictions are higher, that I see more upside. And I did raise numbers on the other indexes. So the NASDAQ, I had an estimate of 20,000. I've raised that to 23,000. My target for the Dow had been 48,000. I've raised that to 55,000. So these are big increases. And it just, and the Russell, I had a 3,000 target and I've raised that to 3,300. So that, ironically, I think the next closest person to me is somewhere down around 5,300 of the strategists on Wall Street. And a couple of them might say 5,500 if everything goes right. So I'm way outside of any norm here, outside of any strategist other than myself. So be it.
Yeah.
That's my I put out what I see, and I'm raising targets partially because I look under the surface and I see a lot of groups and a lot of stocks that have very bullish formations that say they have plenty of room to run. Last year, that all the way up, the call was that the market was very narrow. The Magnificent Seven was why we were up here. Most of the market wasn't doing what the indexes were doing. And people were very bearish because of that and talked down the market because of that. And I kept saying, and my view has been from long ago, that we were going to see a broadening of the market as we move closer to the top, that the melt up would be a broad-based rally, not a narrow-based rally. That's unusual. If you're going into a top, typically markets narrow. Leadership drops off. Some of the stronger, some of the groups that were going up, as you move closer to the end of a cycle, drop off. So you get a narrower market, and then at the end, a smaller group of stocks leads you to the top. I think this is going to be the opposite of that. I think you're going to see a broadening rally into the top. It narrowed and then it's going to broaden out again. And so, do I think the election cycle is part of this? I think if it is at all, it's a small part. Somebody asked me the other day, since Trump did so well in Iowa, is that a sign that the melt up's going to be driven by more confidence that Trump's going to take the presidency back and we'll get back to more capitalistic tendencies? I don't think that's what's going to drive this at all. I think this is much more. It's about interest rates. It's about, as I say, the narrative that I think drives the melt up is a sense that the economy is not going into recession, that we're going to have a soft landing, and that interest rates are going lower, that inflation has been so-called conquered, or at least is going back towards, if not at, the Fed's target. and that the Fed is going to back off tightening, so that the real headwind that's been holding the market back, which is Fed tightening cycle, is going to go away. So there'll be no more headwind of a Fed tightening, and there'll be a tailwind of Fed easing, rates starting to be cut. And as I say, I'm not really worried about it. I don't try to forecast how many cuts are going to happen in 2024, or how much the Fed's going to cut, or when. The bond market's doing the cutting or doing the easing for the Fed. We're already down. The 10-year was down 120 basis points from its high rate last fall, and fell in the last couple months of the year. It's backed up over 4 again. But that's, you go down 120 basis points, you go back 30 or 40 basis points, that's no big deal, that's normal. But ultimately, I think rates are trending lower. I'm still saying during the melt up, you could see a 2.5% 10-year, so still a ways to go on rates. And in the bust that follows the melt up, I think you could see a 0% or even a negative 10-year rate. So, but that will be because of bad news. That'll be because of an economy that's really faltering. During the melt up, it'll be because inflation's been conquered and the Fed's backed off.
Very nice. Before we get to the bust, let's analyze and go deeper under the hood with this melt up. We want to know what you're seeing and what's giving you these signals to not only be bullish and say melt up, but now you're raising your targets. And that's pretty significant. I mean, another 10% higher for the small caps. That's for the Russell. I mean, that's significant. So, okay. So election year, my thoughts are the Fed is more accommodative. And like you just said, the Fed is there. They're not going to be raising rates. They may be cutting, whatever they're doing. They're going to make sure the market will be doing what it does. And they're not going to, be too tough on any way. I mean, inflation is coming down a little bit. We're seeing a disinflation now in the 3s. Now they're projecting maybe in the high 2s. We'll see. The bond market is doing the Fed's job. Exactly right. Agree completely there. They're down in the 4s now with the 10-year low 4s. Okay. So let's go under the hood and please tell us what signals, what you're seeing that lets you feel that this melt up is coming, and it's even stronger than you thought before.
Yeah. So just to kind of unpack that a little bit, I believe the melt up really began back at 4,100 on the S&P back at the end of October, beginning of November. And I said so at the time. All the rally from October 2022, where we went from 3,500 to 4,600, that whole time I said, this isn't the melt up phase. The melt up phase will come. We're in a new bull leg, but the melt up will come. At that time, I said it'll probably come once we make new highs. We had that back off from 4,600 down to 4,100. Investors got very bearish and started talking about, back to the lows again. And then we came out of that at 4,100. If you remember, we had a very strong first week out of that bottom, some big moves. And I said, I think the melt up is starting now. I can't be sure yet, but I think, the melt up means a steeper rally, and you're going to see it more sustained. It's not going to be, 2 steps up, 1 step back. And sure enough, we had, that 2-month rally at the end of the year was pretty phenomenal in terms of, I think the S&P was up 17% during that time, and the Nasdaq was up over, I can't remember what it was, over 30. But so I think the melt up started. People get confused because I talk about melt up and then I talk about parabolic melt up. The melt up means, just as I said, it's more oomph than just any old rally. It's it's very sustained. It's it's what we saw the last 2 months of last year. But then as we get closer to the top, it's going to go vertical, and it's that vertical that still is to come. We're not in that yet. So you can still have these step backs where you have a 2 or 3 or 4% pullback. That's not taking away the melt up, or saying, okay, that wasn't the melt up. So you can have pullbacks until we get to that really final blow off stage. But I think we're in the melt up. What am I seeing that's causing me to raise it? Part of it is how sentiment is acting. That wall of worry that was amazingly sound through all the rally, the year's rally from October of 2022 to October of 2023, or basically rallied till July and then corrected for 2 or 3 months. But even during that rally, that wall of worry didn't really come down much because everybody was so sure this is just a bear market rally. They all were sure, what the Fed was doing was going to cause a real crack up. And so we're just going to sit in defensive stocks and bonds and things because we really don't believe this rally is sustainable. And like I said, it didn't change until really the last couple months of last year. It began to switch over to where, hey, maybe I'm wrong. Maybe we are in a new bull market. And so, all that year, the wall of worry stayed intact. And it's that wall of worry, which is another word for bearish sentiment. That wall of worry is the fuel for higher. If you have a low wall of worry, if people are not worried, then you better be more cautious. But when you have plenty of people, not only talking bearishly, but they act on their talk. They, particularly institutions, if people are bearish, that means they've already acted to protect their portfolios because they think it's going back down. So we have sentiment in a place, in other words, wall of worry or sentiment in a place that says there's plenty of fuel for the upside. Not only that, but because people are generally so bearish, that means they're positioned that way. And that means they have to, if they're changing their mind, they have to reposition more bullishly. So that means coming out of cash. That means switching more from a bond portfolio to more of a equity emphasis. That means switching from utilities and other defensive stocks into more aggressive stocks. All those things are things that, as you see the sentiment move more bullish, you will see in the market. And so those argue to a broader, higher market, and that's what I see coming. When I look technically, because I look at things fundamentally, I look at things from a macro perspective, of course. I look at things from a sentiment perspective, but I also look at things technically. And when I look at, I talk about cross markets. When I look at cross markets, I look at them to see if they tell me a story or whether they kind of wind together in such a way where I can develop a conviction of what they're telling me. And technicals basically tell me that there are a lot of groups that have plenty of upside ahead. Yes, we had the Magnificent Seven, and yes, we had large cap tech do well last year. Semiconductors did pretty well, but we also had other things like industrials that went to new highs and are hanging around near their old highs. That argues we're breaking out, and there's a big another leg ahead. We have financials starting to look better, which they had been a real drag on the market for all that rally, most of that rally, and they're starting to act better. You go across the board, technology still looks good to me. Some of the big cap laggards are starting to act better. Semiconductors, as good as they did last year, they have, to me, a lot of upside still in what I see. Home builders, as good as they've done, and in spite of the fact that we're heading for trouble down the road, they look like they have legs for higher. So when I add up everything I see underneath the surface, it argues that we're not anywhere near a top. From a distance perspective, from a time perspective, you look at those numbers I gave you, and from where we're at, and I'm talking 50% rally in probably less than 6 months. That's unheard of. I mean, and what I have to remind people is that means, you know, 3 to 6 months is very, that's trading land. I mean, that's not long-term investing. But what makes it different and difficult is the 50% is the kind of returns we would normally get over the course of 2, 3, 4 years, and probably typically 3 or 4 years, even with 3 or 4 good years. So yes, it's, if I'm right, it's 3 to 6 months away. It's, it's, you don't want to get too cute. And, if we're going to look at a big bear market after that and think you can call it right to the week, the month, or even the quarter. However, what makes this difficult and different is the returns are more of what you would, if you say, well, I'm 3 months away from my top, I'm going to start getting very defensive here. You might miss what would normally be 3 or 4 years worth of returns. So if you get what I mean, it's you have to not only look at the distance, but also at the time, but also the distance. Of course, I can be wrong, but my convictions are pretty high that what we're looking at here is, I think 2024 is going to be a very historical year.
Wow. And I think in many ways it'll be historic. We've been kicking the can, it seems, with this recession that's being pushed off maybe into next year now with this bust, and we're going to get into that. But I want to talk about liquidity. The Fed injected, I think it was 5 trillion. I mean, significant money during COVID, unbelievable money that was printed and generated during that time period. And so my question to you is more of an economic view. And do you think it's because of all that's transpired in recent times, COVID and the Fed and all this liquidity, that's like a catalyst for this unprecedented melt up? Because it seems like there's just still so much money in the system. Although the money growth is down significantly, I think it's down at the fastest rate since 1939. That's Professor Steve Hanke actually gave that number. Our money growth is down, and that affects us for a recession. But there is still liquidity and still plenty of money in the system. Would you say that's part of the reason why we're going to be seeing this?
Not so much the reason for the melt up, but it is the reason why this thing is playing out over a longer period of time, why we didn't roll over, and does give you room for a melt up. But I think the melt up has much more to do with maybe where we are,
sentiment, yeah,
and with sentiment and how investing, social media, today's generation of both professional and retail investors, algorithmic trading. When I came into this business, I mean, we didn't have computers on our desk. We barely saw a quote machine to know what was going on day by day. It was really, we were focused on long-term investing and fundamentals. That was 1973 when I came in, but really, the advent of the PC was 1980, and it was probably another, I don't know, 7 or 8 or 10 years before we got the rollout of all these trading systems and things that now retail has available to them. Institutions are much more trading oriented. The pressure that has come on now for quarterly performance, and maybe even shorter than that, hedge funds have become a much bigger factor. As I said, algos have become a bigger factor. It all speaks to people making much more aggressive, shorter term bets, and and obviously charts and all the things you can design with a computer today to give you signals lends itself to much more people trying to do things in a shorter fashion and pick something that they can get in and get out 2 weeks later and have made 10 or 15% in, or they might be longer than that where they're making bets. But what it does, I think, amazingly, is it creates even a bigger herd mentality And so what I think is that the melt up is a result of the fact that we had what happened in 2020, and then the two years of tremendous run up, what I call the first melt up, and then 2022, people really reacted. People, and I should say institutional investors particularly, but both really reacted to the fact that inflation broke out, the Fed started tightening, you had Ukraine, you had a lot of things. And in that first half of 2022, you saw people get very bearish and start talking about, and of course, even back then, I had a global bust forecast longer term, not that it was coming then, but and I started seeing back at me a lot of my discussion about what a bust looks like and what what we were headed for down the road. And they kind of brought that all front and center and forward and decided that's what we were heading for because the tape was going down, and we had fallen from 4,800 on the S&P down below 4,000 and ultimately down to 3,500. My point is that I think we saw a huge herdish reaction where everybody got on the same side of the boat. We don't get that often, but when we get it where everybody agrees, it's easy to go the other way. As a contrarian for me, I mean, it was just so clear to me, as much as I was worried about the Fed going too far down the road, et cetera. I was plenty critical of what the Fed was doing, et cetera. I still said, with sentiment where it is, there's still a big move up before we get to that. And sure enough, this last 15 months and what will ultimately be 18 or 20 months, I think it's the fact that when you have that almost trumps everything else. You can do all the intellectualizing you want as an economist or as a strategist about the problems out there. Ultimately, when you have a herd all gathered, and I'm mixing metaphors, but all gathered on one side of the boat, and then the tape starting to drag them over to the other side. Ultimately, it's that shift from bearish to bullish, and ultimately that shift is going to happen in a concentrated period, because as I described earlier, they fought the rally all the way up. They started to get on board late last year, and then they get this pause again. I think once we push above the old highs, this pause doesn't turn out to be what they think it is. They're going to say, oh, I didn't get that opportunity lower to get back in, because they probably have abandoned, many of them anyway, the idea that we're going to new lows. I think they just want a better chance to get in at a better price. So they say, it's valuations are high, the market's overbought, there's too much bullishness. I think we can get back in. Some may think 4,600, some may think 4,200, but they're waiting for a better entry point. When that entry point doesn't show up and we're at new highs, they're not only having to abandon, this is a long-term bear market, they're now having to say, and I'm not getting that entry point back down there, I better get in. When that decision becomes one that everybody's making at once, I think you get a buying stampede where you could have, over a course of 3 or 4 months, an awful lot of money come on one side, all to the buy side, with that being, so it's kind of the opposite of what we had in 2022, when everybody was trying to get to that side of the boat, the bear side of the boat, and they were all selling. So it dropped pretty precipitously. Now you're going to have that same group trying to get back in, and they'll be short covering. Rates will be down, the dollar will be down, the algos will say, gee, this is bullish. So I think you'll have an awful lot of agreement. And I get at on Twitter a lot, people are starting to sound like you. Aren't you worried that too many people agree with you now? And I go, you have to understand, as a contrarian, I'm contrarian at both extremes. I'm contrary as a bull when everybody's a bear at the bottom, and I'm contrary as a bear at the top when everybody's deciding this thing has legs and they're bullish. In between, the consensus oftentimes is right. So I expect to gravitate from, it's not gonna, you don't want to stay contrary all the way through the move because you'll miss it.
I love that. You're very steadfast in your principles, and we respect you, David. Love that. And you know what? You're right on, as a behavioral economist, and you seem to combine all of the economics, human emotion. Never underestimate human emotion. And it does lead the cycles. And that's what fuels these cycles is people. And, you're right on about as soon as there's a little bit of a sell-off, everyone turns bearish so quickly in this market. Everyone right away, that was a bear market rally and we're going to go down, new low, and there's all this talk. So exactly right. You got those bears. It's those people who quickly turn bearish. So they're going to help fuel this melt up and this parabolic melt up, right? And so, there's a rise in information, like you said. Now everyone has access to almost too much information. So they move quickly, they have a lot of conviction, and when they see this thing going up, everyone's going to jump in on that side of the boat. The herds are going to come in. I love that. Makes sense. So let's go deep into the sectors and the industries. You already said the rates are probably going to come down. You may see the 10-year go way below 4. You said maybe in the 2s. The dollar's going to come down. What are your thoughts on commodities during this melt up? People are very bullish on crude, and they're saying crude is going to be going up. A lot of people are long crude. What are your thoughts on energy, oil, uranium, which has had its parabolic move already, it seems, but it is the uranium prices are going so high. Metals, agriculture. What are your thoughts on all the commodities there?
Yeah, so from here to the end of this cycle, there's, we'll talk longer term later, but what I call my pre-bust, I think the commodities
Pre-bust.
will, the commodities will do pretty well. I do think the dollar is going to fall from, it's run a little farther early this year than probably I expected or most people expected because it had come down pretty well and looked like it was heading south. I'm not too worried about the dollar here. I think it'll roll over soon, and I have a target. I guess the dollar is at 104 and change. I have a target at 80, so that's a huge drop. That will certainly be fuel for commodities. I have to say, the one commodity that doesn't fit my, what people would think I would say is energy. I've been a bear on energy, as you know, and when it ran back up to 95 last summer, I guess, late summer, maybe it was early fall. I had people saying, "See, you missed it. You were bears too long, and this is going up again. We just had a quick sell." I said, "No, I don't think so." And my target had been 60, and I said I still keep that target of 60. And we're back at 70, down from 95. And I think we'll probably see 60 here in the next few months. Certainly by second quarter. And so that bucks the trend. Most of the commodities I think will be rallying, not because the economy is great, but because the dollar is coming down. So in dollar terms, they will be rallying. Oil just has, I think there's the producers here are producing tremendously. I mean, I saw something recently where the number of wells is down, but the amount they're getting out of each well is up. And so you're getting a lot of production out of the U.S. There's some production coming online elsewhere, or oil coming online, from Argentina maybe, and from Iran, et cetera. So the worldwide economy is slow and getting slower. So demand for oil is trending down and supply is high. It's going to keep pressure on oil. So it's the one commodity that I don't think is, and I think oil stocks as well, are not in my group of stocks that are going to lead. It's not one of the groups that I think is going to be a leader in this melt up. But the other commodities, I think copper producers, they're not acting well right now this week, but I think copper producers, I have a $6 price on copper. There's still a tight supply demand situation there. Yes, China's weak, and that has an influence, and certainly has influenced it this week, I think. But ultimately, I think copper's heading up this first half of the year. Copper prices and copper producers should follow that. So they're in there. I think steel looks like it's a group that's going to perform. Again, I believe the economy is heading for a recession. So this may seem a bit backwards, but it's how markets work. Markets, again, the narrative that I think is going to drive this is that yes, the economy is slowing, but we're not going into recession. That's not my view, but that's the narrative that I think the street will have. So if they're seeing rates coming down and the sense and inflation coming down in the sense that the economy isn't going into recession, that's like a sweet spot. That's, they'll say, gee. And so in other words, the Fed did its job. Maybe they did thread that needle, and so they get more optimistic about the market, meaning soft landing, and then we can, if inflation's under control, we can look to a new, a new cycle. We never really had a down cycle, where we never really had a recession. Again, that's going to prove, I think, wrong, but for a few months, that's going to help drive the market. So that helps. If rates are coming down, it helps home builders, as I said. I think semiconductors look great, and they've done well. I think some of the old big cap, the FANG stuff, most of that looks good, and the artificial intelligence will continue to be something that people will build on because it's a longer term trend story. And then, I do think consumer discretionary is a little harder to figure out exactly, but I think there's going to be pockets there that do pretty well. Financials, I think financials are going to be a very big driver in this melt up. Again, with rates coming down, and the sense that maybe we're not going to have a real crack up in the economy. That means, banks, their loan losses are not going to get awful, and they can benefit from a spread type of situation in rates. So I think financial, and as I said to somebody the other day, I think the broker dealers look really good. So again, if you're looking for 7,000 on the S&P, it's pretty easy to draw a bullish story, and both the retail brokers and the more institutional oriented brokers, investment banking, etc. So I think that's a first half story. I'm sure I'm leaving out things that I think really fit into the bullish part of this in terms of sectors. But the laggards will be the defensive stocks. So utilities, they'll benefit from rates coming down. So they'll go up. It's not that they're not going to keep up with the indexes because they're utilities. And
staples.
Probably consumer, staples, again, it's not that they're necessarily going to go down, but they just can't keep up when you've got that kind of a market.
Yes,
so
exactly.
it's going to be a lot of the cyclicals, a lot of the value plays that have catch up in them. It can include things like autos and airlines. I'm not particularly close to them to say, they're not screaming at me as places where I think they lead, but they'll probably play along. So that's why I say discretionary can play. I am worried about the consumer. He's, as you say, he was given an awful lot of money during the pandemic, free money, and that's allowed him to stretch things. But at least for half the consumers, the have-nots, they're getting hit from all sides in terms of trying to make their budgets work. So the haves have plenty of money. You've got the wealth effect in the home prices of the last several years. You've got stock market near all-time highs, and they have plenty of discretionary money. So the haves are not a problem in terms of keeping this thing afloat. But the have-nots are a big number, and a big chunk of them are just trying to put food on the table and make their budget work, because inflation has eaten away so much. So I'm not Pollyanna here saying everything's fine. I'm just saying I think we have enough of a runway here to have that sweet spot work for us, and then you got to start worrying about the other side of the mountain.
Exactly, well said. It seems to be this lag effect. We're in we're coasting, and so we have this going on right now. But then this is part of the pre-bust. This is the end of this secular bull market that we have 41 years, and now it's going to end with a big bang, literally a parabolic melt up. And so I want to go into the bust. Now that we've talked about this, we have a broadening of the rally. You had Russell hitting 3,300. That's significant. That is a broadening of the rally for sure, because we had the Mag 7 last year. Now we're going to have small caps. Okay, so that's that. Now we're going to go into the cycle, the end of this cycle. And to me, with the massive fiscal spending that's going on, the debt hitting 34 trillion with $1 trillion in interest expense at higher levels, and massive consumer debt as well, makes sense to me as an economist that we're going to be having a severe recession. Unemployment numbers are far worse than what they're reporting if you go under the hood, and we don't have to go into all that, but basically labor participation rate is lower than it was pre-pandemic. Lots of headwinds, and the macro is very bearish when you go under the hood. So tell us about this bust. Probably the end of this year, next year. Your thoughts, David?
Yeah, so I think that's a good term, under the hood, because I describe it as what makes this cycle somewhat unique is the pandemic. So yes, I mean, people forget. I guess it's been 4 years, but we shut down the economy in the second quarter of 2020 across the world. I mean, it never been done before. We just stopped it. And then we flooded the system with money and all kinds of fiscal stimulus to make sure we didn't just go into the abyss. And not only did we do it here in the U.S., but we did it across the globe. So it can statistically, I mean, it's still pretty phenomenal if you look back at that period and what we did. We were in uncharted territory. Nobody knew exactly what was going to happen, but it looked pretty dire, not to mention the pandemic itself. And yet we came through that with this 2020, 2021 market melt up, and also an economy that held together. And, savings went through the roof. You had the highest savings rates you'd ever seen. You had, that's what money does when you just give free money away, both through the printing press, the Fed's printing press, the central bank's printing press, and government handouts. That's what happens is you can manage a system for a while. The problem is it creates fragility because, as you say, under the surface, not everybody came through that period without being hurt badly. Not everybody, and people mismanaged free money. They thought it was here forever. So, a lot of that got kind of frivoled away. It takes time when you shovel $5 trillion into the U.S. economy or into the U.S. system, and similar amounts in terms of fiscal. It takes time for that to work through the system. It doesn't go away in a year. And that's what I think we've seen from 2020 to 2024 is that it kept the economy afloat. It's not necessarily a efficient way to keep it afloat. In fact, it's not an efficient way to do it. And there's a price to pay for it. And I think that's what the bust is. It's the payback for doing such a crazy thing. I mean, just to put it in perspective, I don't think people really understand our Federal Reserve balance sheet in October of 2008 was 875 billion. That's the largest balance sheet the Fed had ever had, going back to 1913 when it was created.
Mm-hmm.
From 2008 through the next many years, we had, if you remember, we had QE1 and QE2 and QE3. We grew the balance sheet up to something like 3.6, 3.8 trillion. So we went from 875 for, almost 100 years, and then all of a sudden, went up, fourfold from there.
Mm-hmm.
So that was already outlandish, and people were pretty critical of it, and how it was propping markets up, and the Fed was just kind of giving you the Fed put was alive and well, and but then the pandemic hit, and we went from 3.7 trillion to 9 trillion over the course of the next
Mm-hmm.
couple of years. And I mean, it just, again, people need to remember we were 875 billion, probably 15 years ago, and we're now, we're under 8 again because of QT, but we went up to 9 trillion. That's, I mean,
Mm-hmm.
and we're seeing that around the globe, somewhat similar in terms of the money that was created. It creates all kinds of dislocations and inefficiencies in the system, and ultimately it created inflation. We lived through 2022 and 3 because of that money. It ultimately, with a lag, creates inflation. Too many dollars chasing too few goods.
Mm-hmm.
And but what it also did was it drove debt levels to levels we've never even fathomed before. So and because inflation broke out, interest rates broke out, and as a result, your cost of financing, of servicing that debt, surprises on the high side. And that's what you just mentioned, the $1 trillion in servicing costs here in the
Mm-hmm.
US, just for the US debt. It's larger than our military budget.
Yes.
And so you quickly are seeing that the servicing costs of our debt are going to eat up a huge part of our budget. And that means something else has to give.